We've never used our money to invest in real estate. The key is to use other people's money. In today's video, what we're going to discuss is how we use whole life insurance to invest in real estate. My name is Darius.
And I'm Carmen. Now, the key to know is that Darius and I have been investing in real estate for over 10 years, and we have learned a lot along the way, and we love investing with real estate using the cash value from our whole life insurance. So before we jump into all of these amazing notes, make sure you subscribe to our YouTube channel and like this video because it significantly helps us grow our channel. Now, what I want to do is before we go into the 5 ways we have invested in real estate using our whole life insurance, I want to put 30 seconds up on the clock and explain what we are talking about in the first place with using whole life insurance to invest. So let's go ahead and start that clock. So Darius and I purchase whole life insurance policies personally for 2 reasons. We want to make sure that we have a death benefit in place to cover our assets should something happen to us. And we want to make sure too that our money is always going to grow in a compound environment, meaning we're earning compound interest that grows uninterrupted. So when we learned that we could do this through whole life insurance, we said, how can we then use the cash that grows inside of the policy called cash value and utilize that to make more money? So that is the whole premise on this thing, is we recognize how to leverage our dollars and use it in more ways than one to invest and solve our financial needs. All right, so point number 1 is gap funding. Now, what is gap funding? Typically what happens when a real estate investor is investing in a deal, they may not have all of the funds to cover the entire investment, hence gap. So gap funding is a phenomenal way for beginning investors specifically to get involved in a real estate deal if you don't have a ton of money. And that's where we got in. So for example, you could do gap funding for as little as $5,000 on up to 6 figures plus. It just really depends on what the investment is and how much more money the investor needs to cover to make sure that the entire renovation, investment, whatever it is covered financially.
So how we personally did gap funding is we found real estate investors who purchase a property and need just a little more money to get them over that hump so they didn't have to use funds from an additional place. That was us. So we raised our hand, said we will do the renovation for this property. When that property is sold, we, along with the investor, earn a profit for our participation.
Exactly. So like I said, this is an amazing way for you to get your foot in the door just so that you can start seeing what's going on and decide if you want to move into the next point, which might be point number 2. So the next one is fix and flips. So what fix and flips are is typically a real estate investor will buy a house that needs to be renovated, right? And then they will put it back on the market. So these are quick turnarounds, right? We're talking about investments, at least these first 2, that should profit quickly. And the reason why I want to make sure we stress this is because when you are getting a loan from your whole life insurance policy, you need to make sure that the exit strategy makes sense for the specific loan that you're requesting. I've realized that we're not talking about this from a numerical breakdown. If you want those details, then I definitely suggest that you click on the link below and join our Wealth Nation community, because we have numerical breakdowns inside our community that you can watch on demand, right? So in this video, and especially on YouTube, we just want to make sure that we give you like the high level overview for you can get the concept. And if you decide that you want more information, then pop over into our community.
Right. Now, the nice thing about fix and flips is the fact that we were doing gap funding on so many different deals that we understood what it takes to actually purchase one of these properties. And we decided that we wanted to do the fix and flip ourselves and earn a profit from the sale of that property.
Yeah.
Now, again, this is 2 stepping points, 2 stepping stones for us. There was first the understanding of how to buy properties, and then 2, the understanding of us how to buy the property ourselves and then sell it.
And once we realized too, because for example, we were doing gap funding in Arizona and Darius is from South Carolina and had some hookups, and we realized that we could actually buy entire houses with the amount of money we were investing in gap funding, and the numbers made sense. We could make more money by taking over the entire project as opposed to having a piece of the project. So we said, let's try our hand at fix and flips. We did a few deals. We said we liked it. And then we wanted to move on to a more passive play, hence point number 3, which is rentals. Now, what are rentals? If you are not familiar, that means you purchase a home and you put tenants in, and they are going to pay you every single month to replenish the mortgage payment that you have on the home. And you are responsible for repairs, maintenance, and all of that. It is not on the tenant to do so.
Right. Now, the nice thing about that is with us, we use our life insurance our life insurance policies, loans, so we own the properties outright. So they're making payments back to us, and we're able to use those funds to reinvest in other properties. And it's important to understand that this is a long-term play. because of how we actually use the money. It's really important for us to have these different streams of income, even within real estate, so that we can make sure that there's always constantly money coming in, replenishing itself so that we can use it again to make more money.
Now, one thing I want to make sure that we're clear on is sometimes we find people underestimate rentals because they don't bake in like maintenance fees or even having someone monitor the property for you. Those are other costs that you have to take into consideration. So before you get a loan from your policy, again, make sure the numbers make sense so that all of the money that's coming back, you can replenish that loan so you can continue to cash flow in other properties.
Right.
Now, let's move on to point number 4, which is seller financing. Now, I particularly love seller financing, if you can't tell. And the reason being is because I find like this is so similar to what the banks do. I mean, they're involved in any of the points that we talked about, but like it just made me feel like we had moved up in the world when we were able to do seller financing, which is when you finance the home yourself. So you are the mortgage owner. Right? So you basically can sell a contract to an individual who wants to buy your home from you, and you're just financing the deal. So they're paying you principal and interest every single month, and now that person moving into the home is responsible for the maintenance, for the repairs. Kind of sounds like home ownership, right? Is we pay the mortgage every single month, but we are responsible for any repairs that happen to our home. And what happens if we default on those loans is the bank starts all over with somebody else.
Right. So we start over with somebody else, just like the banks. And I really like that position because it really allows us to be that third party and stand in between, just like the banks do to finance the things that we want in life. Yeah. And if we want to be successful in anything, be successfully financially, we need to follow somebody that's financially successful. And the best example of that is the bank. So when it comes to the seller financing, it allowed us to really understand that position and that role and the importance of it, not just because of our position, not just because we're using life insurance, but because of just the overall flow of money. Because this is applied in other streams of income. It doesn't change. The process doesn't change. Yeah. The only thing that changes is the characters that are in play. So this is something that has a bigger understanding that I hope you're following, where you can apply it in your life right now, not just real estate investing.
Absolutely. It can be with any investment, right? So the last point that we're going to talk about is crowdfunding. And we lovingly call this crowdfunding. Essentially, it's a bunch of investors coming together, pooling their funds to invest in a large property, for example, or a large investment, should I say. So let's say like it's a $5 million deal, and the investor needs to bring a bunch of people in together to fund this deal.
Now, we don't have $5 million in cash value, but this gives us an opportunity to rub elbows with these people that are finding these deals, so that we can understand how to do it ourselves. It allows us to diversify our real estate portfolio, and it allows us to kind of like with gap funding, we had to learn first before we can get into these $5 million deals. Yeah.
And the whole process with this that I hope you all are seeing is all we're doing is requesting a loan from our life insurance policy to fund an investment. And like we were just saying, it doesn't have to be real estate. You can plug in any investment, X marks the spot, so that you can always make sure that you are earning more interest. And we love the ability, again, like we said earlier, to be able to have compound interest being earned inside of our policy, plus the family protection coverage, in addition to be able to invest. Like there's no other place that we have found that we can do this while being able to build wealth for our families at the same time. So just to recap really quickly, again, we talked about gap funding, we talked about fix and flips, rentals, we talked about seller financing, and we talked about crowdfunding deals.
The point we really want you to hone in on is the difference between using your savings versus getting a loan. When you use your savings, what happens is you're no longer earning interest in your savings account because that money isn't there. You withdrew those funds to invest in real estate. The alternative that we're offering is the fact that we personally use our cash value life insurance to invest in real estate. Now the money sitting inside of our policy is continuing to still earn interest because we didn't disturb that compound interest. We got a loan from the insurance company and used their funds to invest in real estate. Now the difference also, we're earning interest and we're also paying a small amount of interest. We're not doing anything different that the bank is doing for your savings account. They use the deposits that you put into the bank for your savings, and they're investing to a mortgage. Now that mortgage is being paid back principal and interest. Your savings account doesn't change. When you use your loan and you own that contract, you can dictate the terms of those things, and you can continue to earn interest by growing your policy and interest from the investment itself.
Absolutely.
We're saying to do two things at once.
So these are several ways that you can start investing in real estate using whole life. Many of you are always asking us, how do we invest in real estate using whole life? And we hope that this video was helpful. Now, if you want to start thinking about using other assets, then definitely click on our next video.
Remember to own your own lifestyle,
or someone else will.